Hello, this is Abilash Jaikumar, co-founder and managing director of TresVista. Today we're discussing the state of secondaries 3.0. We've done this for the last few years, and this is the first year we're doing it post-pandemic. I have the privilege of being joined by some of the leaders in the industry. I'd love for them to introduce themselves. Nigel, if you'd like to kick us off.
Sure. Nigel Dawn, I'm head of private capital advisory at Evercore. We advise both GPs and LPs on liquidity solutions for private markets.
Hi, I'm Andrew Hawkins. I'm Vice Chairman of Strategic Equity at ICG, the predecessor business I founded back in 2012, and we've always only done GP-led transactions, as I'm sure we'll talk about a lot more in the moments to come. And right now, we are entirely focused on doing single asset continuation vehicles, which again, I'm sure is something that's going to be an interesting discussion.
Thanks. My name's Derek Krouner. I'm a managing director at BlackRock, leading the strategy in secondaries. Our strategy is a little bit more down the middle of the fairway in secondaries, where we prosecute GP-leds like Andrew's strategy. We also do traditional deals where we buy portfolios, and we really try to attack part of the market that we feel is underserved, which is really the mid-size part of the market. We'll do sort of transactions of all shapes, and I've been here for about 3 years, and prior to that I was at Goldman doing secondaries.
Wonderful, thank you all. Maybe to start the conversation, I'll direct it towards you, Derek. Maybe just talk about how the volumes have changed year over year, and and the volume rose the first half of this year, surpassing the volume we witnessed last year in the same period. What's your take on this, and what steps are being taken to overcome the expected inflationary risks?
Well, I think generally, the secondary market is been very healthy, heading into whatever an economic, disaster, whatever the press is saying. I think we've always been, for many years, a niche strategy. We would transact less than $10 billion a year for a decade, around the GFC, to today. We did 130 billion in 2021, depending on who you ask. Nigel can check my numbers. And I think that is really a reflection of something more structural, which is just people in private and illiquid markets wanting liquidity and having an option to manage their portfolios on one hand, and on the other hand, GPs having the ability to offer solutions to their LPs when it comes to extending the life of funds and all sorts of activities like that. And now we're sort of in the mainstream, and it's a real asset class. It's one that has performed very well, and again provides a real solution. And as we head into this year, and if you think about the first half, it was a record-breaking half in terms of volume. This next half might slow down, and again, we'll ask Nigel what he's seeing. It's going to be serving a very important purpose as liquidity gets drawn out of the market, and people need to reformulate their portfolios, and that's where we can step in. So really, I think from that perspective, structurally, the secondary markets is in a great shape, and we've developed a very institutional and formalized approach. I think we just need to raise more money, and because private equity is, as we know, is exponentially grown on the primary side, and the secondary market should be a reflection of that growth going forward.
Maybe Nigel, you'd like to add on to what Derek's saying, looking at a perspective.
I think. So sorry, I'm with Derek on that. I think it was a really busy Q1. Q2 really, in a sense, was really lower. And the second half of the year is being challenged for all the reasons we've seen in the public markets, which is then flowing through to the secondary market. So our expectation is certainly this year will be down on last year. How far? Who knows at this point? But I don't think like $110 billion total transaction year would be unreasonable. We're about, I think, depending on which advisor you ask, around 130 last year, 135 billion. And I think it's a market right now. It's firstly, it's a market that, in a sense, is chronically undercapitalized. It's the need for capital in this market. Going back to volumes, though, we had a very busy Q1, and off a record 2021. And what happened in Q2 is that volumes were down materially. So heading into the second half of the year, pretty subdued, and that's continued for the second half of the year. So for the full year, we're probably looking at volumes maybe around 110 billion, down from around 130 last year. Activity is down, particularly on the LP side, where many investors, I think, are waiting to see how GPs valuations change at the end of the year and into next year. And there's sort of a view that you could be buying at this time, you could be catching a falling knife. So there's a little bit of a standoff, and perhaps for the first time in literally years, the value of being a liquidity provider has never been higher, and I think the secondary market understand that very clearly, and are frankly using that power, I think, in the market right now. So I mean, that's sort of how I see things generally right now, but also curious to see what Andrew thinks.
Yeah. And for a number of years now, the secondaries market has been growing year over year. There's two different markets here, in the traditional secondaries and portfolio trades to the GP-led secondaries. And we've seen GP-led secondaries space growing maybe a little faster and constituting a larger percent of the market of secondaries. And we see that trend continuing into this year. Andrew, maybe you'd like to talk about how the dynamics specifically for growth of the GP-led is varying vis-a-vis traditional secondaries.
Yeah, well, I think that there's a lot of moving pieces in that question. And I think that if you look back in history, the traditional secondaries marketplace has always declined in volume in recessionary or market downdrafts because of one simple reason, which is valuation expectations. And as Nigel says, you don't want to catch a falling knife. And even if you've got material discounts, and we're starting to see a return to significant discounts creeping into transactions in the LP secondary side, which I'm not very well positioned to comment on, except I sit in the investment committee of a fund of funds vehicle, and so I'm a little bit of what I'm seeing, but Derek and Nigel will see much more of this. There's clearly a contraction volume because people just don't know where to price, and paradoxically, and I'm sure everyone knows this, but GP value, private asset valuations, tend to be, they're very muted in their response to market conditions, unless a particular GP is heavily exposed to the public markets. Then there's much less of an impact than you'd think from just observing the S&P. And in fact, we've seen in this particular fund of funds business actually a slight growth in NAV so far this year. Although I think there's more to come in the next part of the remainder of this year and next. So you've got on the one hand, you've got this quite marked contraction of volume in the LP side, LP secondary side. At the same time, the GP-led space is actually perfectly suited for this market. In other words, if you are a GP trying to give liquidity to your LPs, and they know that it's difficult for them to trade in the secondary market except at a big discount, and they know that cash isn't coming back as quickly because the conventional exit markets, the M&A and the IPO, are hampered by a whole host of factors, including valuation, but also including the lack of availability of adequate credit. You see a natural contraction in the flow of cash back to LPs. And so the GP-led market offers an ideal way of unlocking some liquidity for LPs. It gives a transaction possibility for GPs who are wishing to do something with assets under their control. And one of the beauties of it, frankly, is that in most situations with GP-led transactions, you can step into the existing capital structure without having to refinance it. And so they're transactions which are easy to get done. They are in some ways an alternative, I wouldn't call them an exit, but they're an alternative transaction route to M&A, particularly where you're looking at GPs wanting to extend ownership of assets that they know and love. I foresee actually no slowdown whatever in GP-led transactions, save for one critically important thing which Nigel highlighted, which is that the market is chronically undercapitalized. It's a bit of a mystery to me, to be honest, because it's a very logical place for LPs to put cash. The secondaries market generally ought to be much more highly capitalized than it is for a whole host of reasons we can come on to. But I think that, you know, the GP-led space in particular offers some very compelling dynamics, and it is surprising to me that more capital hasn't been formed in that area.
Yeah, you know, regarding capital constraints, you know, in one of our previous discussions, Nigel, you had mentioned that syndication is a preferable course of action for secondaries due to these capital constraints. You know, as a fundraising activity is slowing down in the current market conditions, do you think syndication is going to become increasingly a challenging strategy as well?
I think it will be challenging in the same way as fundraising is challenging. And so if we are heading to the syndicate market to complete a transaction, I think that LPs face the same challenges and headwinds they do in the primary market, in that they're over allocated to private equity as a general matter, particularly those who are in the United States, particularly those in public pensions. It's a little bit of a different picture, I think, if you go to the Middle East and perhaps Asia, but even so, less so Asia right now. And, you know, roughly about 50% of our transaction volume goes to the syndicate market. What tends to be very challenging right now is particularly large transactions, and particularly large because what we have observed, with one notable exception, is that the size of the lead check has gone down from a year ago and 18 months ago. So, you know, we just completed a $1.5 billion single asset transaction where the lead check, you know, was about from a secondary fund was about 150. And so what that means is that we, as an advisor, have to go far and wide, much more so than we used to. And, you know, as a result, that smaller transactions, those that require equity of less than $1 billion, are as a general matter, much easier to execute. So I think we're going to see some of the same pressures, but it's certainly the case that in the syndicate market, sophisticated investors who focus on net returns and can realize on a risk adjusted basis a single asset transaction versus a co-investment, a completely different risk profiles. And that a co-investment generally, you know, you don't know if it's going to be the best or worst performing asset in that GP's fund because it's a new transaction. For a single asset, you already know it's one of the best performing assets where the GP's already, you know, generally speaking, made about 3 times the money. You know, that's the average multiple that a GP is crystallizing in transactions that we've executed over the last couple of years. So, you know, I think the sophisticated investors look at net returns rather than all you know, other aspects of the transaction.
You know, Derek, you had mentioned earlier in this conversation that secondaries have really evolved over the years to really be its own standalone asset class, you know, apart from providing liquidity and diversification benefits. You know, how has this dynamic played out in the private equity market this year? Maybe I'll pose Andrew's question to you. Why hasn't more capital been drawn into this market?
It's a great question. I think it's just we have grown super fast, while not necessarily as fundraisers, you've been able to educate people on the benefit of secondaries by itself and away from private equity. Now, the one thing I will say is, although a lot of people will say I don't have any more private money to invest because of everything that's happening, denominator effect. There are more questions than ever, at least coming into us around, hey, talk to us about secondaries. Shouldn't this be an awesome time to do secondaries? Like, they want to talk about it as an opportunistic play, which is what we want, right? We want people to think about it, as a theme, and not just sort of a small allocation that they make to kind of mitigate J curve, which is one of the benefits of secondaries. But I think what we really have to do a better job is really showing the market that, one, the deals we're doing are hard. They're not easy to structure. They're not easy to execute. It takes a lot of resources and a lot, and that's why you're seeing sort of the platformization of secondaries happening, because it does take a lot to get them done. And so there is real value to committing to our strategy and to committing to managers that can do these things. You can't do it on your own. But two, it's where is it placed in the risk return spectrum of alternatives? We have the data. I mean, but the easy answer is it's equity like upside with credit like risk. And then you have this whole other element that Andrew can talk about, where if you're doing the single asset concentration side, there's a positive skew bias to the asset selection that you don't get on the co-investment side or doing deals on your own. And so what's the end result of that? Well, we've done secondaries now for decades. I can't find a fund, maybe there's one on Preqin that's lost money, right? So you've got great downside protection. You've got a lot of elements that you want in a strategy that looks like credit, but has really good equity-like returns. And so maybe you don't get the upside of, when you compare it to a first decile manager or first quartile manager on direct PE or growth, but average PE, it actually stacks up quite well, if not exceeds it, and then you're at a low risk. So we need to do a better job as managers of getting people to look at it as a differentiated strategy that offers transactions that you cannot do elsewhere. And I think we'll be successful in that, right? I think we really will be. I think it's just a matter of time. And I think going into this market, this is our time to be as big as cheerleaders as we can, because this is our time to shine. It really is. If there is going to be protracted downturn, there are going to be assets that we can buy, liquidity that we can offer, and our returns should be the best that they've ever been. So, as an asset class, I think it does kind of stand alone, and it's really fun for us to talk about because the data is there. People just need to start to allocate to it, more strategically and in a bigger number.
And Nigel, I'd love to get your thoughts on this same topic as well. Obviously you have a relationship with the LPs as an advisor helping them broker, but these same LPs are also the ones who will be the anchors in these secondaries funds. How do they think about when they use secondaries as a tool versus when they look at secondaries as something they want to invest into as a strategy? Is it the same people in those organizations? Is it different people? What has to happen to actually accelerate this space?
Well, unfortunately, it's often the same people. So you have a little bit of debate within their brains. It's a great time to buy? Is it a great time to sell? So, and obviously then, I think we see a movement perhaps with LPs to more of a relative value approach to the asset class. And sometimes you can still sell well into this market with the right sort of assets, and they do still price well. The buyers are still using leverage, and then that capital then can be redeployed at a time where potentially prices and valuations can be more biased. So a lot of people invest time have thought about secondaries as a trading, almost like a trading strategy. You pin the market, dip out the market, depending on the valuation environment. And I think if it's ever a time to think entering the market, it is probably now. And I think that perhaps the difference between some previous downs, at least my observation, is the level of over allocation for many investors, particularly in the States. It is not 1 or 2% base allocations. Typically, it can be 5 to 10%. So I think there's a view in the market, Abby, that there's potentially a capitulation on the part of LPs, in that you're going to get mass selling next year, because boards of particularly public funds are going to force investors to sell at least a portion of their portfolio to get them back into the range of what is an appropriate allocation for private equity. So there's a bit of a standoff right now, as I see it, and I think that sorts itself out beginning of next year.
But isn't there another question here, Nigel? And I completely agree with that. That if you think about big secular shifts in the investment spectrum, there's clearly a trend towards private assets for a whole bunch of reasons, performance being high among them. And yet it seems bizarre to me that, with a few exceptions, only a small proportion of LPs or institutions are actually really making material increases to their private asset allocation. And it seems like there's a disconnect somehow, that obviously people should be putting more into private markets, but the actual decision makers at the investment committees of those firms are just not going along with that. And so that seems to me where the problem needs to get fixed.
I think that's right. I mean, I think all these things take time, and the classic asset allocation between equity and then fixed income, equity publics versus privates, has that cycle has not worked its way through yet. So some of the more sophisticated institutions clearly think about equity and equity risk versus private equity risk, public equity risk, and so I think generally those institutions tend to lean more these days towards private equity, particularly those who have, that their pension payments are out in the future. So, but having said all that, I think given the previous fixed income interest rate environment, that institutions have not had a choice but to lean more to privates, because otherwise, to make their actuarial rates, they've had to lean into private credit, lean into private equity, and also clearly lean into secondaries as well.
Hey, Abby, one anecdote I wanted to just give, going back to the point that Nigel made around, we do have that question a lot, which is like, I'm selling a portfolio in the market, but you're pitching me on secondaries. Like, what if you go buy that portfolio? I'm not, it's just one side of the house to the other. There's a number of ways to answer that question, but one story that I thought was funny, we bought a portfolio in my Goldman days from an LP of ours. They awarded it to us, and then their secondaries team co-invested in the transaction. And you think about, like, why would they ever do that, right? The answer was actually kind of simple, was that we could just manage the portfolio more efficiently, right? It wasn't a great use of capital on their balance sheet of the parent, but when we buy the assets, we can employ leverage, we can risk mitigate around some of the public exposures, we can do a number of things that they can't do that actually make it a better risk return. And obviously they were taking line items off their balance sheet. They didn't have to administer that. There's a cost to that. We inherit that job. And obviously they weren't, they were taking just a small piece of it. But I just thought that is sort of an interesting example of, people can sell on the secondary market, but they also should be investing at the same time. And in this case, it was the same deal.
Yeah. And I can imagine, Derek, somebody of your experience and wisdom would have pointed them in the way of a highly experienced advisor to help them.
Yeah, you guys did not sell that one, but you've taken a lot of share from that particular intermediary since, so you're fine.
There is one little bright spot on the horizon, by the way, while we talk about capital formation, if I may, just for a second, which is the individual investor market. We're talking a lot about institutional LPs and their constraints, but there is a very big shift happening towards private individuals and high net worth, and actually even a sort of more democratization of private markets. And I was speaking at a conference with one of the people that we've worked with in the high net worth side, and it was clear that increasingly advisors are telling people not to have, you know, a 60-40 equity bond portfolio, but more like a 25 private, 35 public, and, you know, so there's a much more fluid idea. And I think that with the demise of defined benefit pension plans, you're just going to see people putting their 401ks into these things, as well as a big expansion on the high net worth side.
Yeah, you know, we use the word LP, but it's not a legal definition. Many people can fall into that bucket. Historically, when we talk LP, we mean the big pensions and endowments that are in lots of capital, but in a volume, not in terms of dollars, but in terms of actors, that the volume of individual actors that are smaller in nature are certainly multiples of those of the institutional LPs, and they will become an increasingly important part of the equation here. It's interesting, Andrew, you mentioned the split, how much should be private versus public. When we think about the absolute value of the assets that are out there, right, there's not a 25-35 split between private and public. So if even a fraction of the assets got reallocated to alternatives or private, we'd be in a situation where we probably have more capital than we did. And that the demand for yield should see that happen in the years to come. But in the same way, we don't talk about, you know, the different types of LPs. We don't talk about the different types of GPs always, right? There is no legal definition of middle market. I meet a fund manager with a $300 million fund that calls themselves middle market, and I meet someone with a $700 million fund that calls themselves lower middle market, and I meet someone else with a $1.5 billion fund, right? And they're very different in what they're trying to pursue as far as the assets that they are investing in, as well, and their LPs base as well. Now, Derek, you had mentioned that you know, you are involved in middle markets at the start of this conversation, and Nigel, you've been advising the space a very long time. What has happened as far as middle markets and secondaries, and what has to happen for secondaries to gain more prominence in the middle and lower middle markets?
I think there's plenty of. I mean, I think the secondary market's prominent in all of PE. I think that you know, one of the thesis we had when we started the practice at BlackRock and where we are today is just that middle, and we call, instead of call it middle market, we call mid-size transactions, because I could still buy a piece of a large buyout fund that's just smaller than, you know, what one of my larger competitors might buy, and so that's not a middle market strategy, it's mid-size. But on the GP-led side, I mean, there's thousands of managers out there that, you know, and a subset of those are very high quality and have good companies that have LPs that want liquidity just the same as the big guys, and so there's a lot of places to go to find interesting transactions. The check sizes just might be smaller, and so from our perspective, that's a better competitive dynamic. Now, I think you take a step back, it's like the supply demand dynamic's good everywhere, but I think especially in the smaller side, when a lot of competitors just keep getting bigger, who's going to fill that gap where just, you know, smaller deals need to get done. But I leave that. I think Nigel can answer that, because I know he's probably meeting with a lot of smaller GPs that want to do deals.
Yeah, I think so. I mean, I think the definition of fund size has always been as much a marketing question as a technical question. So, and if we look at the majority of the deals we do, I think the GPs would probably categorize themselves as mid-market. And particularly, you know, I think particularly in the single asset secondary market, one of the key reasons a GP wants to do one of these deals is because they don't want to sell their best asset to a larger GP. So by definition, it's almost, you know, it is almost a mid-market strategy in large part, just because it allows a GP who's traditionally operated, you know, and built a company, sold a company up to a larger GP, you know, has an opportunity to really, it's, you know, perhaps final exit. So I think there's many transactions in this market that would be below $750 million of total value, below $1 billion of total value. Where the third party raise maybe 5 to 750 million. So I think in some ways it's a fairly natural part, Abby, for the secondary market to play.
Yeah, and when we think about the different types of LPs as these funds get smaller, often you get a lot more fund of funds as potential LPs, not the institutional limit, but not the insurance company or the pension or the endowment. How does a fund of funds view a secondaries transaction as far as it relates to that they have to go back and explain to their LPs, how they calculate returns or liquidity?
Do you mean if a fund of funds sells their interests,
Yeah,
or if they have to do like a
GP? A fund of funds is the LP, and I ask this question because some of the fund of funds I've spoken to aren't necessarily keen on, secondaries transactions. They'd rather have the asset be sold, right, and get a liquidity event that way. And why would a fund of funds maybe have a different attitude towards secondaries than an institutional LP?
I don't know if I've seen that, because I guess, in theory, BlackRock has a fund of funds business where they commit to primaries and co-investments, and then obviously by definition secondaries can become a fund of funds. But I know that BlackRock has been super active in selling their old tail end funds in the secondary market to wrap up old vehicles, and on one hand, and then I think on the GP-led side, liquidity is king and cash is king, especially in this market. I think they approach GP-leds with a constructive lens if the price is right.
That's right. I mean, as a general matter, I've observed that any limited partner, when offered to crystallize a 3 or 4 times the money return, tends to have a fairly positive lens on that.
Yeah, I guess that's what value they're getting at the secondary.
I think one of the constraints sometimes, Abby, in fund of funds is they have a specific end date for their fund, and if the continuation fund runs longer than the end date of their fund, sometimes it's difficult for them to participate just because there's a timing mismatch between the continuation fund and their fund. But and so I think that's often the reason why a fund of fund may want a asset to be held to the natural end, but it's just it's not a big issue that I've noticed from my perspective.
And they also might just be a little more discerning in the sense that, like, they're set up, they have the resources to do more work on those types of transactions, right? They probably have a secondaries arm, and so when those deals come in, they have the staff, the infrastructure to do a little bit more work, and so maybe they ask more questions and they're a little bit less motivated to just take the money and run.
Another thing I'd like to discuss is the competitive landscape. In years past, we had actually discussed one of the limiting factors to growth of the space is the number of qualified, talented individuals who actually get secondaries, right? This has grown very rapidly. And it seems most people in the space know each other fairly well because it is fairly a small space. But increasingly, there are new investors in information asymmetry or some factors that help LPs position themselves in the market. How will the entrance of new investors shape the liquidity and competitive dynamics in the coming year? Andrew, maybe if you'd like to tackle that one.
Yeah, I mean, you're right. We've seen a very rapid growth in activity in the secondaries market, and it's interesting how both the sort of industry leaders have managed to grow their fund sizes, and you look at the likes of Strat Partners and Ardian and Lexington, and they're raising monster funds, and there's obviously a lot of support for that, and they've got a very important spot in that ecosystem. But we also noted earlier that returns are very attractive, both whichever end of the secondary spectrum you're at. It's either at the LP end, the conventional end, where you've got very consistent, very reliable returns with as Derek was saying, like credit, like risk exposure, and on the GP-led side, you've got this sort of tremendous positive bias of backing the best GPs with their crown jewel assets for a continuation fund, and where you've got very low risk there because the GP knows the assets inside out and hired most of the C-suite, knows all the competitors, the regulatory threat. And so you've got these, as an industry, it's very attractive. And the returns that you're seeing seem to be consistent and worth pursuing. And so just natural laws of economics mean that people will come in to fill that void. But it happens really slowly. And you've seen a number of folks who are multi-strat asset managers going into the secondaries marketplace, hiring teams, buying companies, and generally speaking, trying to grow their exposure. But it takes time because there's a shortage of people, right? How many people understand it? It is quite a small, intimate community of folks who work in this space, and obviously you can increase that over time. But it's also the lack of capital formation, and we've heard a number of sort of horror stories in the past 1 to 2 years of people who've set out with really good intentions to build sizable secondaries practices and have stumbled because the capital's not there. And so I'm kind of that guy, sort of breathing into the fire to try and get it to grow, because I think it's good for everyone if the pie is bigger. But it's certain that it will grow. I mean, I think there is no doubt in my mind that the secondaries market is woefully undersized. I think it's very interesting. Our dear friend Jan Robard, who famously at a conference about 6 or 9 months ago said he thought that the secondaries market would be $1 trillion by 2030, and maybe that's an ambitious target, but I don't disagree with the general direction. It's just woefully small for what it does. It's an extremely good system for investing in private assets, and I think that the influx of competitors is helpful because it's more pressure, more people whispering in the ears of those institutional LPs, and indeed those wirehouse banks and RIA networks, that this is an asset class that needs to be more properly capitalized. And so hopefully that influx of competition will help that. I don't think it's going to have much impact on returns in the next 5 years because I don't think it can grow quickly enough. And so I'm cheering it from the sidelines here.
Yeah, I think Andrew hit on some great points there. It's interesting when you think about like a very high quality private equity company that comes to market, call it $50 million EBITDA, great margins, unique market leader. The bankers there are probably trying to get like 30 bids, or something like, maybe not today, but like, in a normalized environment, like 30 bids. I mean, there's that many private equity direct shops out there. But on a single asset deal or a portfolio that's $1 billion, you might get 5, and that gets cut up between those 5. So it's, you compete in 2 ways, right? Fundraising and on winning deals. And I think on the winning deals part, it's more, honestly, it's more collaborative than competitive right now, which I love because I really like everybody in our industry. It's great.
Everybody?
It's great to most people. Yeah, I know. Most people I've met with, it's a friendly club, I'd say. A unique job that we have. And so it's great. It's great to win together. And I think, anytime that there is a competitor that gets announced, we lost a couple of people on our team to Apollo. I'm not, what was weird. It was a weird day, but 6 months later, I'm happy that they're in the market. I'm happy that they're there. I'm happy that they're helping to commercialize and grow our industry, because the pie does need to get bigger for us all to do well. And that's a great dynamic for us right now.
I think the key, like you say, is validation. That I remember when I started off on the advisory side, I think there's one other advisor, and there's probably 30 advisors these days. I don't know. It's grown, and we found it really hard.
Fairly, Nigel, right?
No, I'm not an advocate of equal market share, obviously, but I think it's healthy. But when I started off, when there's only one other advisor, it's pretty hard convincing people that this is sort of the thing to do. When you have 10 people telling somebody that this is a great idea, it's different. So I think the LPs, once they have 10 managers saying this is a great thing to do, let's thinking on the GP side for now, then it will be different. And just in terms of, it takes time. Just think how long it took to get co-investment programs in place for investors. It'll just take some time, but it will be there over time.
It's funny. Another anecdote on just like we think about Goldman, big secondaries platform. That's where I came from, and they've always tried to avoid hiring a group like Nigel's because of that conflict that could arise. But they finally bit the bullet. They hired an advisory team in the last couple of years because sponsors now don't, if they're going to deal with you and try to hire an advisor, they want to. Where's your continuation fund team? It's you have to have it now to even have real conversations with sponsors on winning business. So it's fascinating how much it's grown.
Thinking about market expansion from a different angle, thinking about it from a geographics perspective. Historically, North America has been the center of secondaries, but last year we saw a third of the volume came from outside North America. Nigel, what, according to you, is driving the growth in this direction, and which geographies are expected to experience the upside of expansion?
It certainly outside North America, Europe it has to be the number one, because I think a lot of the private equity strong there as America. So we've seen a lot of activity here. Next I would say is Asia, but it's still a fraction of the activity that you see in North America and Europe. So I think Asia comes next, but it'll be slower. But there's certainly transactions. All the reasons why a GP, for example, would want to execute a GP-driven transaction are the same in Asia as here, and perhaps more so in countries that don't have a developed M&A market. So it will come over time.
Yeah. Speaking just on availability of capital, the dry powder situation, a lot has been spoken about the dry powder available in underlying private equity and how much has been allocated to it. We've spoken on this in this conversation about the limited capital for secondaries. That's not to say there isn't capital available, but how do you kind of view what our current dry powder situation is in terms of increasing transaction volumes, right? What's the pipeline you have for allocation, and are you thinking maybe being judicious about where you allocate capital because the next fundraise might be a little further out? Derek, if you'd like to kind of throw some light on the supply demand dynamics here.
Yeah, I mean, I think we've touched on it, right? It's undercapitalized. We've got less than a year of dry powder for a market that has trillions of dollars of net asset value, and then another trillions of dollars of dry powder behind that. If we can just increase the turnover of that value just a little bit, we'll get to that $1 trillion market that Jan said predicted. And so I think that even in the best of times in terms of valuations, and when maybe things were a little bit more competitive in the last 10 years, like it was still, secondary still performed super well. And now when we head into a period of dislocation, I think it's going to do even better. And the biggest challenge we have is capital raising. Because as we convince more people to come to market, GPs and LPs, if the price demand, if the bid ask spread gets wider and wider, they're going to get bad taste in their mouth. They might not come back again the next time. And so we need to make sure that doesn't happen.
Historically, anytime there's a new asset class, once it gets to a critical mass, one of the things we see is new regulations, right? And amended rules for private fund advisors recently proposed by the SEC. They proposed that sponsors will be required to obtain third-party valuations of GP-led transactions. Now, as a matter of best practice, that's being done, right? And it kind of needs to be done to get the deal done. But, what complexities do you kind of anticipate coming to market? Andrew, you had mentioned previously that you think more retail investors become part of the story at some point. So how do you think regulation can shape the secondaries market going forward?
Yeah, look, I think on the specific point about third-party valuations, I mean, they're quite commonplace anyway. I think they're actually they're good practice. I think we have to obviously be cognizant of the SEC's desires here, but I'm not sure it's going to be a massive disruption to the market. I do think, however, though, that as the audience expands into not just the sort of the wealthier elements of society, but actually into sort of the mass affluent and the retail investor, then you're going to see a lot of regulation necessary, because historically that group of people has always been much better protected than institutions that are thought to be capable of looking after themselves and with the right internal processes. So I do foresee there will be more regulation around the private wealth market. I hope it isn't too much, because I think it's actually a really smart thing. If you're an individual investor, it's a very smart thing to have exposure to private assets, as we were talking about earlier. And so the shame would be if the regulatory net became so tight that actually it became impractical. And I don't think that's going to happen, because there's a clear motivation in the political environment as well as the regulatory environment to make this possible. And in fact, but going back to this democratization point, it's a little unfair if you are, Joe Blow with a small 401k, that you've got zero exposure to the best performing assets. I mean, that feels unfair. And so hopefully when our regulators are thinking about how to control and avoid problems and catastrophes for individual investors, which is highly desirable, that they do so in a way that's quite benign, because it'll actually shouldn't exclude people who would otherwise come into that marketplace.
Great. Maybe to close here, I'd love to get your predictions for where the market's going. And this is where I miss Jan. But I would love for each of you maybe to give me, what do you think the transaction volume for 2023 is going to be? And how does that split between GP-Leds and traditional secondaries? Nigel, if you'd like to go first.
So I tend to think this year, I've mentioned, will be down on last year. So 22 first would be my guess. It would be around 110, maybe 120. My prediction next year is will be about flat to this year. I think we're heading into a challenging year. It takes time for valuations, as Andrew mentioned earlier, to reset themselves. So I tend to think it would be around flat, and then my expectation is the following year. So just for extra credit for 24, I think it could be materially up.
And how do you think it's going to split between GPs and traditionals?
I suspect it will be around 50-50 again, which I think it will come out around 50-50 this year.
Derek?
I don't have any wild predictions outside of that, honestly. I think the first half of next year could be down, I think, and that's going to be a reflection of just a tougher fundraising environment for us, because we do get lumped into the overall private equity allocation, which is fair because we are liquid, but we hope that there's more opportunistic dollars that people can deploy to counteract that. But I think it'll firm up, and there'll be the price discovery and the bid-ask spreads will start to narrow. Deals will still get done. There are assets that will continue to do well, that are priced fairly, GPs that know what they're doing, that can go on offense in this market. And I think that's really where we're going to see the deployment trends, is backing more defensible assets and provide real dry powder so that they can take advantage in the M&A market. I think that'll be where the strong GPs make some hay. But yeah, I think it'll be smaller check sizes, a little bit less risk, a little more diversification, and so probably a muted 2023.
Andrew, you want to bring us home?
Well, I love it when the smart guys go first, because I can just agree with them. They know what they're talking about. I mean, so I think Nigel and Derek are right on the money. It's historically, as I was saying, there's a contraction in volume when you have price discovery issues, and an unwillingness to take steep discounts. So I think even though it's nominally a buyer's market for LP secondaries right now, it's still going to be muted volume. And I would agree with Derek. I think the first half of next year is going to be quite down on volume, certainly versus the first half of this year. Paradoxically, though, I think the GP-led market is going to continue strongly. So my personal prediction is certainly in the first half of next year that GP-leds will exceed LP-leds in volume, because they're rational transactions. There is capital available to execute them, and there's no need for external financing, and so they're not only rational, but they're doable transactions, and they're desirable transactions. And on top of that, you've got not only the logic of it, but GPs becoming better educated, more familiar with these kinds of opportunity, and realize that they're extremely beneficial to all parties, as again, referring to Jan, what he would call a win-win-win, where everyone is actually better off as a result of that transaction having happened. So I think that that GP-leds will outpace LP-leds, certainly for the first half of next year. I agree with Nigel and Derek. I don't see that you're going to see much volume increase. I think it'll probably be pretty flat. But I think 2024 could be a monster year. I think if we can get the recessionary forces behind us, there'll be pent-up demand. There'll be some dry powder that hasn't been deployed, and I think we'll all benefit from a very strong uptick in that year.
Well, thank you, gentlemen, so much for sharing your thoughts. I'm sure we could continue speaking for the rest of the day, but we got to go do deals now. So thank you again. I look forward to catching up with you in this same panel next year.
Okay. Thank you very much.
Thanks, Abby.
Thank you.
Thanks, Abby.
Bye-bye.